Hello everyone and welcome to our webinar for March 2025. My name is Kate Chalker and joining me today is our presenter, Adrian Bailyey, who I'm sure all of you are familiar with. Now, I've no doubt that over the last few weeks, you've been inundated with various emails and articles on the recent Bendel decision, which was handed down by the full federal court on the 19th of February. And in today's webinar, Adrian will be taking us through this decision and what it means for UPEs and other Division 7A issues moving forward. Before we get into that, I've just got a few things to run through. Firstly, if you would like to download a copy of the slides from today's webinar, you can do that by clicking on the Files button on the right-hand side of the screen, and from there you'll be able to download a PDF version of the PowerPoint. Secondly, if you do have any questions that you would like to put to Adrian throughout the course of the presentation, feel free to submit those by clicking on the chat button, again on the right-hand side of the screen, and from there you'll be able to type and submit your questions. I'll be keeping an eye on those throughout the course of the webinar, and I'll put those to Adrian at an appropriate time. Lastly, just to remind you all that today's webinar will be recorded and will be uploaded to our website and our YouTube channel at a later date. So if you need to leave the webinar early, not to fret, because you will be able to access it at a later date. So with all of that said, I will hand over to Adrian to start today's webinar.
Thanks, Kate, and welcome everybody. Just like to repeat Kate's welcome and welcome you all to the webinar today. We're going to be running through Division 7A, obviously concentrating on unpaid present entitlements to corporate beneficiaries, and particularly in relation to the most recent decision of the Federal Commissioner of Taxation and Bendel. So our agenda for the day, or this presentation, will be how did we get here? So we will run through starting from 16th December 2009 up until Bendel's decision, the sequence of events as to how we've got into this position for clients. Going to touch on the key parts of Bendel, do a bit of a crystal ball gazing and consider what the likely ATO approach is going to be in the short to medium term in relation to these matters. Have a think about what we could do to deal with existing arrangements, whatever they are in place. And of course, there's a few different things that could be in place. Consider strategies moving forward, and just touch on, see bits in Fin Review and other newspapers about how this is going to be a tremendous cost because everyone's going to be amending their assessments. And just to have a look at that point and see what is there to actually amend. So, not everyone on the webinar has the same level of knowledge, so we will step through all of these points here in a bit more detail. Some of you may not have even been in practice on the 16th December 2009. Some of you may already been retired on the 16th December 2009 and still keeping your hands in. But what we'll run through is that publication that eventually became Taxation Ruling 210.3 and PSLA 210.4 and the sorts of arrangements that we could put in place under it. The Board of Taxation recommendations, which were accepted by government, and we had a budget announcement that they would be implemented. Still no legislation on that, of course. Then the introduction of taxation, what became Taxation Determination 2022-11, which resulted in the withdrawal of 210.3, PSLA 210.4, and then, of course, the decision in Bendel of the full federal court released in the last month. So, if we cast our minds back, and perhaps it's best to go to the legislation itself, and where all of this really came about is in the change of the Commissioner's interpretation of what constitutes a loan for the purposes of Division 7A. And if we look at 109D3, which is the definition of a loan, it includes, at Part B, a provision of credit or any other form of financial accommodation. Now, what the Commissioner did in his 2010-3 ruling is decide that if you have a distribution from a trust and it's made to a company, related parties, I guess you could say, they talk about the same controlling minds, and that amount remains unpaid, then the company is providing financial accommodation to the trust, and it is a loan for Division 7A purposes. So that's the core part of where the Commissioner changed his view back on the 6th, or published his changed view on the 16th December 2009. Before that, had been queried on distributing to corporate beneficiaries and leaving it unpaid, and had said, look, that's fine in the absence of some other tax avoidance issue. But all of that changed back on the 16th of December 2009. So, remembering that's the key point, is that arrangement where we have a trust distributing to a company and the amount is left unpaid, is that providing financial accommodation? And is it therefore a loan under 109D3B? So, touching back on Taxation Ruling 210.3 and PSLA 210.4, which we're now in the curious position of them having been withdrawn back in 2022. But they, in essence, created different ways that we could address the situation and be compliant with what the Commissioner was concerned about. Not listed on the slides, but in terms of what he accepted in relation to what you would call pre-December 2009 UPEs, or what became known as quarantine UPEs, you could leave, if they hadn't been converted to a loan, you could leave them as is, leave them on the books as long as there was no movement in them in terms of an increase, then they were fine and you wouldn't take any compliance action in relation to them. The other things that 210.3 and PSLA 210.4 allowed you to do, or allowed clients to do, is either implement a complying Section 109N loan agreement. So that's your standard Division 7A loan agreement when you're lending money from a company to a shareholder or an associate of a shareholder. So if you comply with that within the time period that the Commissioner allowed in terms of when the UPE arose, and we'll touch on that a little bit later, then that was one of the accepted rationales from the Commissioner. The other, so that could be either 7 years or 25 years principal and interest loan. I think one of the issues, and there were some other arrangements which we'll touch on, which the Commissioner allowed, but one of the, real practical issues with putting it on a 109N loan agreement is that you have the annual principal and interest payments, which forces dividends and creates real top-up tax on what you consider to be paper dividends. So in order to fund those dividends, in order to fund the loan repayments under the 109N loan agreement, very often you'd have a dividend declared, additional tax paid on it, and money would come back to the company. So it is a way of complying, but it comes with an extra tax cost. But it's what you call a simple way of complying. It's a well-worn provision. If you have a complying loan agreement, then you shouldn't have any issues with it apart from the extra tax that the client has to pay. The other thing that the Commissioner allowed in 210.3 and PSLA 210.4 was this concept of a subtrust. And what he did allow, and there was two different variations of it, there was a 7-year and a 10-year subtrust with slightly higher interest rates. But he said that if you put these amounts of these UPEs on a subtrust for the benefit of the company, you pay interest at this rate, depending on whether it's 7 years or 10 years. You don't have to pay out the principal loan up until the end of the 7 years or the 10 years. And I'll say that you're complying with Division 7A and with my new ruling. A few major problems that have always existed with subtrusts and their arrangements similar to that is that it's not within the legislation. If we were to create or we were to comply with the Commissioner's view by a 109N loan agreement, then we have that provision within Division 7A that says that such a loan is not subject to a deemed dividend. We don't have a similar provision within Division 7A in relation to these concepts of these subtrusts. And so there's always the risk with them that we're relying on the Commissioner's good graces and administrative treatment, because if it ever came to the crunch of it, if we were in court over a dispute, there's nothing in the legislation that we could point to that says that this is not a loan if the Commissioner is right about a UPE being financial accommodation and being a loan for the purpose of Division 7A. So plenty of clients did sub-trusts. However, there was always that risk run with it. The other sort of more practical risk with sub-trusts was human nature tells us that if all I have to do is pay interest for the 7 years or the 10 years, and I don't have to pay the capital, I'm really not going to start chipping down on that capital unless I'm very diligent or have a very good advisor reminding me to. So I'm going to get to the end of the 7-year period or the 10-year period, and that's when I'm going to have to come up with 200,000, 400,000, whatever the amount of the initial UPE is, and pay it down in order to comply with the sub-trust treatment under those rulings. So uncomfortable conversation to have with clients, I would think, at the end of the 7 years or the 10 years. The other issue with a sub-trust, and it's no different to a normal UPE, is that the UPE still exists, and therefore subdivision EA and EB could still apply. Again, no real difference to a normal UPE in that respect, but it's something that sometimes people forgot. Now, as I think of it, I wouldn't say it was a concessionary treatment by the tax office or the Commissioner, but we did start to see the situation where we got to the time where the 7 years and the 10-year sub-trusts that were initially adopted, it came to the end of that 7-year period or 10-year period. And at that time, the Commissioner put out a further ruling to say that rather than pay the principal down at that time, you could at that time convert it to a 109N loan agreement. And in essence, you would have 14 years or perhaps 17 years overall to pay down that principal and interest. Personally, I think there's a few reasons why he made that concession at that time. I think he realised he had some major issues with actual enforcement if people didn't pay down the principal. And we'll touch on that a little bit later in the presentation when we're looking at what we could do for clients or what strategies there are. So I mentioned EA and EB still applying for sub-trusts, much as they do with EPE. So just to recap on that, as I said, not all everyone's level of knowledge on the webinar is the same. But subdivision EA can apply if we have a trust with a corporate UPE and it lends to or pays from an unrealised gain to a shareholder or associate, and then we have a deemed unfranked dividend. And that's one of the things that Bendel is about. And subdivision EB was introduced to catch the use of interposed trusts. So I might distribute from one trust to another trust, and then that trust to a company. If I make a loan from the top trust, is that caught by EA? Technically no, but introduction of subdivision EB made sure that that was caught as well. So moving on in time, we get to 2015 and we have the Board of Taxation recommendations on targeted amendments to Division 7A. So this is some 6 years after our initial change of Commissioner view, representing Taxation Ruling 210.3 and PSLA 210.4. And they were actually accepted in the 2016-17 federal budget. Unfortunately, all the budget papers really said were we received the Board of Taxation recommendations about changes to Division 7A, and we will accept recommendations and introduce them as legislation. It didn't confirm exactly which of the recommendations would be implemented. You could have a guess at some of them based on the list, whether it's all of them or most of them or some of them. But that's where we were at in 16-17 budget announcement saying we're going to implement these Board of Taxation recommendations by legislation. Fast forward to 2025, we're still waiting. It still hasn't been brought in under legislation. Some of the things that were in the Board of Tax recommendations were that there would be a change to the terms of Division 7A or the legislation itself to confirm that an unpaid present entitlement owed to a corporate beneficiary from a trust would be a loan for the purposes of Division 7A. Now, I guess the question is, why do you need a change to the legislation if the Commissioner's right that it is financial accommodation? But that being said, that was one of the changes that was recommended. They also suggested that amending the legislation to include those quarantine UPEs, so those pre-December 2009 UPEs to include those as Division 7A loans. There was also a concept of a change to the Division 7A rules. As you will very likely know, you can either have a 7-year loan or a 10-year loan if you can show, if you have 110% of, 25-year loan, not 10-year loan, if you can show that you have 110% security over the amount of the loan. There was the suggested change was we get rid of 7 and 25 years. All we have is 10-year loans with a slightly higher interest rate, and that will make it simpler for everybody. One of the other recommendations was the removal of the distributable surplus calculation. So if you have a deemed dividend under Division 7A, it can only ever be to the distributable surplus amount of the company, which in essence is the profit of the company, which makes a lot of sense. If you don't have a profit, you can't really have a deemed dividend. So there was one of those recommendations was to remove that. Some other things in terms of what they call a self-correction mechanism, which was a bit unclear. Safe harbour rules for private use assets, which is 109CA. Technical amendments to provide certainty. But probably also one of the other more concerning things was the extension of the period of review for Division 7A to 14 years. So it would become one of the longest review periods within the tax legislation. And it's very likely that the Commissioner had agitated the Board of Tax for this on the basis of having a look at the way Division 7A works. If we have a 7-year loan or a 25-year loan, sometimes it's quite some years before we see where there's been an issue. So he wanted to have the ability to go back 14 years. So as I said, we're unclear as to which one of these were going to be legislated, but we're still in the position where none of them have been legislated. Then along a few years after that, the Commissioner releases what becomes Taxation Determination 2022-11, which is titled Income Tax When Will an Unpaid Present Entitlement or Amount Held on Some Trust Become the Provision of Financial Accommodation. And release for public comment was pretty much finalised in the form that it was released. And it says there's two situations where you're providing financial accommodation and you have a requirement to comply with Division 7A. So that's where a private company has been made presently entitled to income of a trust, and either that entitlement remains unpaid, you're providing financial accommodation, it's a loan for Division 7A purposes in the Commissioner's view, and you must comply with it under section, or comply with it, and mostly comply with it by Section 109N loan agreement. There was a second part where he said you're providing financial accommodation, which was a variation of the sub-trust concept. But I'm not going to talk about it during this presentation because in principle what it was that if you'd set aside an amount of cash for the company in the books of the trust and you held it there just for the benefit of the company, that was a complying sub-trust under this determination and you didn't have a Division 7A issue. Of course, the question is if you had that cash sitting there in the trust, why wouldn't you just move it to the company and be done with it? But that was another way that he would allow you to comply. So where there is a UPE, the determination then goes into effectively the timing of that and when you have to comply with it by putting in either your 109N loan agreement or cash flowing it to the company. And so he said in his determination that a UPE arises where a private company beneficiary is made presently entitled to trust income and that entitlement is not paid. And the financial accommodation aspect occurs where the company has knowledge of an amount that it can demand immediate payment of and does not demand that payment. So when does that knowledge arise? For the UPE, it says the private company has knowledge of the amount, does not exercise its demand to right. Where we have the same directing minds or controlling minds, the client group is deemed to have that knowledge. But again, the question is when is the time that you have knowledge of that amount? And what that depended on in the determination was what your trust resolution said. So if your trust resolution had a fixed amount, in essence, you become aware of that time at the time of distribution. So if your trust resolution says, I give $100 to XYZ Proprietary Limited, then at that time, the company has knowledge of the amount it is not called for it, it's providing financial accommodation. If it's a percentage or it's a balance clause within the trust resolution, the Commissioner took the view that it's when that trust income is determined. So when you actually know what the amount is, that's when you have knowledge of it, and that's when it becomes financial accommodation and a loan for Division 7A agreements. In the determination, the Commissioner says, well, you can either comply with it if before lodgement day you either cash flow the amount to the company or you put it into a complying loan agreement. So there were some examples or some, an example used, which is reproduced here in the determination of that different timing mechanism. So the first one is where you become entitled to 100% of the trust income. So you don't actually know what the income is because you don't know what the trust income is at that stage. Those calculations still have to be done. So what the Commissioner in that arrangement takes the view that in essence, by tax return time in 25, because you only become aware of the income in the 23-24 year as opposed to the 22-23 year, which is when you make the distribution. You only become aware of the amount of the income. So by the time of that tax return time, you have provided financial accommodation and you must enter into a complying loan agreement, and your first payment is due in June 25. So in essence, you have a 2-year window before you make your first payment if you're converting to a Division 7A loan, a 109N loan agreement. However, if the resolution is for a discrete amount, the company becomes aware of that amount, it's providing financial accommodation, and it shortens that time frame to effectively 1 year. So good reason for trust resolutions never to actually specify an amount if you're using corporate beneficiaries. And I should say, there's nothing that's changed since 2009 that says you can't use corporate beneficiaries from a trust. It's just a question of how you deal with them and how you comply with the Commissioner's view. Just for the purpose of the paper, there's also a slide here on the timing for sub-trust funds. But as I said, in my experience, the 2022 sub-trust, very limited use because you actually have to have that cash sitting somewhere within the trust. So that ruling came into effect as of 1 July 22, so it's in effect now. They did state that compliance resources will not be devoted to pre-1 July 22 sub-trust arrangements, so that's the old 7-year or 10-year sub-trust arrangements, and that TR 210.3, PSLA 210.4 will be withdrawn from 1 July 22. Then along comes Bendel, and really ruins this for the Commissioner and just creates more mess for everybody in reality. So initially we had the AAT decision, and I'll come back to how the Commissioner accepted that or didn't accept that. But the full federal court decision, which is the decision that came down in February, the question really is whether a UPE to a corporate beneficiary is financial accommodation under Section 109D, and the full federal court decided no, it's not financial accommodation and not within Section 109D. And I'll go through the reasons that they said that, but I think one of the key paragraphs from the decision is this one that's been recreated here, and it's, if you like reading decisions, it's around paragraph 88 or 89, and it says that the perceived mischief that lies at the heart of the Commissioner's submission is the creation of a present entitlement that is not paid to a corporate beneficiary and remains in the trust, but which benefits from taxation at the corporate beneficiary's corporate tax rate. And I think that's a pretty good representation of why the Commissioner changed his view and why he wanted to agitate so firmly and ran audit programs and was quite active in compliance activities where you have a trust with a present entitlement to unpaid present entitlement to a corporate beneficiary. In reality, he didn't like the fact that you're capping the tax rate at 30% or 25%. So the key parts of the decision of Bendel is, and this is taken from the decision, a few of the key points that the full federal court made. It says Division 7A, first off, itself draws a distinction between a debt and a loan. The two shouldn't be equated, I should say, and the concept of a loan is narrower than that of a debt. And the creation of an obligation to pay an amount to a private company that does not result from a transfer of an amount from or at the direction of the private company. So we've got a trust distribution here that's not a transfer of an amount from or at the direction of the private company, is not a loan within the meaning of section 109D3. And the term makes a loan in paragraph 109D1A connotes something more than the mere existence of a debt owed to a private company. Now, it was accepted by Bendel and the Commissioner that there had been a debtor-creditor relationship. It was created by the trustee resolution and the entry in the trust accounts. But however, the court said that section 109D3 requires more than the existence of a debtor-creditor relationship. It requires an obligation to repay and not merely an obligation to pay. And that's our core part of the decision. There's a difference between an obligation to pay and an obligation to repay. And the court went on to say that the creation of the UPE and the corporate beneficiary's non-exercise of its right to call for payment did not constitute the making of a loan or an obligation to repay an amount, as opposed to an obligation to pay. A loan means we need to repay something. Doesn't mean we, as the company, have to pay something. The trust has to repay us. But a UPE, it's pay, not repay. Words are important, but I think it's a good explanation by the court of the difference between a loan and what could be an entitlement or a debt. We do not have an obligation to repay the company. We have an obligation to pay the company. So, where to from here for the ATO? The due date for application for special leave to the High Court is the 19th of March. So we'll know in about 6 or 7 days whether they apply for special leave. Now, for the non-lawyers on the webinar, you can't automatically appeal to the High Court from the full federal court. What you have to do is make an application for the High Court to grant special leave in order to hear the appeal. Now, special leave is only granted in matters that the High Court thinks have either something that hasn't been covered before within the legislation or of it's something such importance that it must be dealt with. Difficult to see why it would fit within those categories. There's been plenty of case law on what's a debt, what's financial accommodation, but we'll wait and see. In terms of the ATO approach while we're waiting, because first of all, they've got to make application for special leave. I would think it very, very unlikely that they don't. But then the High Court has to decide whether they grant special leave, and then if they do, then there would have to be the appeal actually heard to the High Court. So it could be still some time before we have resolution of the court aspect of Bendel. Now, after the AAT decision, the Commissioner did release a decision impact statement. That is still yet to be modified or changed. There's a notation saying that Commissioners are reviewing the decision impact statement after the full federal court decision, but there's still been, as of today, there's been no update to it. But I think we can get an idea of the Commissioner's likely approach is what will be in that decision impact statement, pending whether the High Court decides to hear the matter. It'll be continue to take compliance action in accordance with the Commissioner's view. So they state that we don't accept the AAT decision. They haven't yet said they don't accept a full federal court decision. That's a bit harder to say. But we are going to continue to take our view that a UPE is financial accommodation and is a loan. In practice, what has been happening with matters that we've seen in this world where there is an audit or review or perhaps even an amended assessment has been issued on a Division 7A matter involving a UPE, is that the Commissioner has, in essence, said, we're going to put the matter on hold until Bendel's decided. If you want to, you can continue to force the matter, and you can continue for us to either continue with the audit or review, or we can continue down the objection phase or whatever phase you are at in the timeline. But if you do that, we are going to continue to take the view that a UPE is financial accommodation and therefore a loan. So for those clients, there's no real advantage to push the ATO into continuing to progress their matter. And so all of those are effectively on hold and will continue to be on hold pending whether anything happens with the High Court. So what could we do to deal with existing arrangements? And thinking about broadly the 4 types of positions clients could be in if they're continuing to use UPEs to corporate beneficiaries or have used them in the past. We could have the situation where we've converted it to a 109N loan agreement in accordance with what the Commissioner wanted us to do. We could have a situation where we've got those pre-December 2009 UPEs on our books, and you still see those. We could have the old sub-trust arrangements, the 7 years or the 10 years. To be honest, I've never seen anyone implement what you'd call a 2022 sub-trust, but perhaps we've got that as well. And then we've also got what I call the prior year distributions. So coming back to our guideline before, TD 2022-11, if we made a distribution in 30 June 23 or 30 June 24, and it's not of a fixed amount, then we're still in that window where we have to decide whether to put it on a complying 109N loan agreement or whether to cash flow it to the company. We're going to have a think about each of those. And I should say there's no hard and fast answers for any of these except for the first one, but it is something that needs to be considered on a client-by-client basis. So if we've gone ahead and complied with what the Commissioner wanted us to do via a 109N loan agreement. So in order to do that, we would have had to have created a written loan agreement signed by the company and signed by the trust. And I'd take the view that we've formally turned that amount into a loan. All of our documentation will say that it's a loan. I think clients have done that in a very different position to clients in any of the other sorts of positions. Because we've formally documented that we have a loan between the two. In order to unwind that, if I could put it that way, we'd have to make an argument that we don't have a loan. And here we have a document saying that this is a loan and the parties accept that it's a loan and these amounts need to be repaid. So I think if you have put in a complying 109N loan agreement, then the reality is that you're stuck with it. And I don't really see methods of dealing with that in any other way. What about our historical or quarantine UPEs, so pre-December 2009 UPEs, which can be quite significant? And remembering one of the famous Board of Taxation recommendations back in 2015 was to bring those into the Division 7A net. So we would have to repay them. If you still have them there on the balance sheets, I guess first option, as always, is just leave as is and hope that the somewhat continued dysfunction continues and we never get that legislation, or when the legislation comes through, it doesn't touch them. We could take that view. You may also then want to consider, if you don't want to take that risk, you may want to consider perhaps forgiving them or dealing with them in some other way. And it's a very strong argument to say that if you forgive a UPE, particularly those pre-December 2009 UPEs, then there is no tax outcome from that forgiveness. And that's really a combination of the fact that if we consider the position that the Commissioner's in order for him to deal with that forgiveness now and say that it is a deemed dividend, he would have to, in essence, say that when the UPE was created, and this is going to be a UPE that was created at the very latest on the 30th of June 2009, so 16 years ago, he would have to say that we had a deemed dividend at that time, because that's his view, it's financial accommodation. If there's a deemed dividend at that time, then we're outside the amendment period to go back and amend that. We can't have a dividend again on a later of the same amount under Division 7A as it currently stands. And the commercial debt forgiveness rules also ought not apply in that scenario. So it takes a fair bit of analysis and to work through and to check what's actually happened with the clients. But there is still a very strong argument that you could deal with those quarantine UPEs by forgiveness. There are some other issues that need to be considered, as I said, commercial debt forgiveness, CGT. what it does to the trust accounts and to the company accounts, but it may be something that clients may want to consider if they just want to deal with it now and not take the risk that they will eventually become Division 7A loans. What about our 7-year or 10-year sub-trust arrangements? Again, remembering they were never within the legislation. So they never had the protection of a 109N loan agreement, and they were very much an ATO administrative approach. Again, if you think about it and you work your way through it, what would be the effect of refusing to continue to comply with the Commissioner's terms of that agreement? He's withdrawn Practice Statement 210.4 and TR 210.3. What could he do? Could he go back and assess on the initial entering into of the subtrust because we haven't complied with the subtrust arrangement? I think, again, you have the same issue in terms of timing, amendment period, with the fact that he would have to argue that his full federal court decision, which says it is not a loan, is a loan. So again, if you work through it, I think there's some very strong arguments to say that you could potentially vary or terminate the agreement. Of course, you could still leave it in place and keep paying it. But again, would be worthwhile examining for clients who have entered into 7-year or 10-year subtrusts. And then we have the people that are kind of in that limbo phase. So who would be on the timeline for prior year distributions? As I said, if it's a distribution 30 June 23 or 24 that has been unpaid, you are still within that period where you have time to decide whether to cash flow it, and this is on the Commissioner's view, whether to cash flow it or whether to turn it into a 109N loan agreement. So for those clients, so let's use 23 for an example. We're coming up to May 25. That's the time by which under TD 2022-11, we have to put it onto a complying 109N loan agreement in order to comply with that. High Court special leave application, the 19th of March. Whether that's heard by middle of May, unknown. If it's heard and it's granted, there definitely won't be a hearing by middle of May. So the question then for those clients, if they've made a distribution in the 23 year, is do we leave it as a UPE? Do we go back to the future, as the topic of our webinar says, and rely on a full federal court decision? Or do we continue to comply with the Commissioner and turn it into a 109N loan agreement, recognising that once we do that, as I said, I think we're pretty much stuck with that. So again, no hard and fast answer for that, and it will depend on talking to the clients, risk profile of the clients, how much the UPE is, what they want to do moving forward. All of those sorts of factors will have to be considered. But again, the reality is that the full federal court has said a UPE is not a loan. We could leave it there in place and it's not subject to Division 7A. 24 in the same position, perhaps have a little bit more time. We should have some finality in this before 24. I got there on the slide prior years. So what if we've got 22 or 21 and we've overlooked putting it on a complying loan agreement in accordance with what the Commission wanted us to do? Again, be worthwhile examining whether we do anything. You could, of course, do some self-compliance, or you could just leave it as is. But again, worthwhile examining and talking through the clients with that as to what the options potentially are and what the best course of action for them would be. Of course, the big sort of unknown with prior year distributions and also the other arrangements is the legislation being changed. Considering where we're at in the political spectrum and where we're at in the timeline of the federal government, you would think it very, very unlikely that they will get legislation through that said they were going to get through in 2016-17 in the next couple of weeks before an election is called. And once the election is called, can't introduce new legislation. The existing legislation that hasn't passed lapses, in essence. So, could it happen? Yes. As in a change of legislation. Is it likely to happen? No. But again, it's something else that plays into the situation as well and continues with, I won't use the phrase that we used internally when we're talking about where we're at, but you can guess it's something relating to a mess. Moving forward for the 25 financial year, for example, what could we consider doing? We could accept Bendel in the full federal court and return to the use of corporate beneficiaries. We could restructure out of trusts, so we could move to a company environment. There's plenty of rollovers that allow us to do that in a CGT free environment. Stamp duty is still an issue in some states, but potentially we could just consider. My clients could think, I'm sick of this mess. I'm sick of my accountant talking to me about UPEs. They've done it for the last 15 years and it's never made any sense. Let's just move to a company and we get taxed at the flat 25% rate. I can see that as an attractive thing to do. Or we could comply with what the Commissioner wants in terms of continuing to use 109N loan agreements for UPEs. So every client is going to be different. And every client, as I said, is going to have different personal situation, different risk profiles. But broadly speaking, those are the things that we could consider moving forward while we're waiting for some sort of finality, if it ever comes. And we've been waiting for 16 years now. It still hasn't come. Is it going to come in the next couple of months? I doubt it, but could always be proven wrong. Last point I just wanted to touch on, because it's been a bit in the Fin Review and other newspapers about this, about how it's going to cost the government $1 billion because everyone's going to be going back to amend their returns. And to me, I'm kind of struggling as to think, what are we actually amending in our returns? If we put that UPE on a 109N loan agreement, we've said it's a loan agreement, we paid interest in accordance with what the terms are. How do we go back and amend? Or what's our argument in going back to amend? If we're going to amend for things that we've had on sub-trusts or something like that, again, it would have been an interest payment from one and a deduction in the other. So what position do we actually end up in? If we've had an audit or a review and we've reached a deed of settlement with the Commissioner, that settlement deed will say that, well, this is the end of the matter. There's not going to be any further amendments or reviews. We agree to disagree, but here's the deal. So we can't do anything there. And then also, if you do go back and then you work out something that you can amend, what would the ATO response to that likely be? And I think we could be comfortable to say that the ATO wouldn't like it and would say they continue to take their view that it is a loan or it is something within financial accommodation. So I don't think actually amending, I think probably open, if you found something to amend in the first place, I think that would open a much bigger can of worms than what you're trying to solve. But there may be situations where it's appropriate to go back and amend. As I said, struggle to consider some apart from perhaps some loss entities or something, but it is a situation where I think that, again, it's the media kind of doing a bit of a beat up there. But I'm more than happy to be educated by someone who can point me to an example of what they're actually amending and how it will benefit for the client moving forwards. And that brings us to the end of the presentation. As I said during it, when we're talking about what to do with existing arrangements and what to do moving forward, it is very client specific. Unfortunately, we're still very much in a grey area, despite there being a full federal court decision to say that these things are not loans. But of course, more than happy to talk that through with clients and yourselves, to talk through what the different options are and what they could potentially do in these situations. So I'll hand back to Kate. Let's see if there's any queries.
Thanks, Adrian. We do have 3 at the moment. The first one is from David, and he asked, in relation to the ATO's current practice of putting audit or review matters on hold, does the ATO communicate that decision to put it on hold to the advisor or the client, or is it up to the advisor or the client to put in a specific request to put that matter on hold?
Yeah, so the ones that we've worked with, and I know you've worked with them as well, Kate, the ATO are proactive in reaching out to you and saying, we are putting this matter on hold because of the decision in Bendel. If you want to continue for us to, say to use an example, consider the objection, we will do so if you tell us to, but we will adopt our view as opposed to Bendel. So they ought to be in touch. Not to say that they're always the greatest communicators, but our experience has been that they do reach out to you.
All right. Next question is from Stefan, and sorry, I'm not quite sure what Stefan means by this. Maybe you'll have a better idea than me. But the question is, can you lose a Section 109N loan agreement? What if it was an agreement covering multiple years rather than a discrete loan agreement for every single year?
Stefan, I think you know a lawyer's answer to that is you can't lose documents. All jokes aside, there's always a pressure to try and do the right thing by clients, but sometimes you can open yourself up to other issues if you start losing documents. If I'm interpreting that the right way, and I may not be.
All right, next question we have from Joshua is, do you see any Section 100A issues arising if we leave UPEs as they are to corporate beneficiaries?
In short, no, because at the same time, obviously, we've had recent decisions which confirm, always been my view anyway, and I'm not saying I'm the smartest person around, but you've got to have that arrangement, that reimbursement agreement in place at the time that you're making the trust presently entitled. And so very difficult to show that, particularly in the year of distribution. And then aside from that, you go back to your normal family and commercial dealing arguments. So I don't really see 100A as an issue in the normal scheme of things, unless you're using loss entities to soak it up or offshore residents. In your normal plain vanilla client group, I don't really see any issue with 100A potentially applying. Thinking this through in terms of ways that you might want to mitigate that risk of 100A, or even mitigate the risk for Division 7A, is what if you stop using the existing corporate beneficiary, you set up a new one, use that for this sort of grey period moving forward, or even if you alternate between two corporate beneficiaries. And I have seen that done by people in the past, where they alternate between corporate beneficiaries, but maybe that's an option as well for clients to further reduce that risk.
All right, next question is from Kate, which is, what are the implications, if any, if we're dealing with a new trust and company arrangement? Are there any different considerations that we need to take into account?
Not particularly. As I said, we're in the position now where we've got the full federal court decision to say that it's not a loan. And the question is, do you go back to just doing UPEs, or do you continue to what you call toe the line and what the Commissioner wants you to do?
Thank you. Next question from Harry. So with the amendment period being a maximum of 4 years without any fraudulent activity, what is the situation for loans given beyond the 4-year mark?
Yeah, so of course you've got to go back and look through what's actually happened. But if they're beyond the 4-year mark, and there's some sort of issue with it, then you can't go back, and the Commissioner can't go back and amend. And that's one of the reasons why I think he was propagating the idea of the 14-year extension for amendment periods for Division 7A, so that he has the capacity to go back and do it. And sometimes you see situations where there's a Division 7A issue, and just for whatever reason, it hasn't been picked up by the client or the advisor for 6 or 7 years. And so the question is, well, what should we do? Well, in those situations, the reality is you're outside the period. There's been no fraud or evasion, which could potentially extend it. And so very often the end advice is, well, you don't have to do anything.
All right, thank you. Next question is from John, asking you to do a bit of crystal ball gazing. But John's asking, are we going to have a big problem down the track if in, say, 3 years we've got legislation introduced where UPEs do become a loan, and in the meantime we haven't done any 109N loan agreements, and we've lodged tax returns ignoring any interest? Will there be lots of amendments needed then after that legislation, or do you think it will restart at the time of the change of legislation?
I'll just get my crystal ball going over here. I think I've always been of the view that you should address the things as they are now and not worry about what things are going to be in the future in terms of, and we've seen plenty of examples where there's been an announcement about legislation that's going to come in, and it's going to turn the world upside down, and it never comes in. So I think you go on the basis of the way that the law currently stands. If there's a change that comes through, there's a change, great. And I think one of the examples, in the Shorten election period, when Bill Shorten was running and there was going to be the change to superannuation, and people were talking about taking everything out of super because of that, recognising there's been other changes since then. But that's an example of a situation where you're in a better position to just wait and see what actually happens and what the legislation actually is. If you think about the fact that this has been a live issue for the last 16 years, there's a reason for that. It's because there's not a lot of political appetite to bring forward this legislation, change it, despite the perceived mischief.
Thanks, Adrian. There's just one question that we have left from Stephen. That was just asking, what was the double tax argument from Bendel that was made?
Sorry, I'm not, mustn't have read that part of the judgment. So that may be in relation to actually the fact that what the court said was that in essence, if you have something that is not with a UPE, what they're worried about is you kind of end up in the position where you get taxed twice, in that you have tax paid on the initial distribution to the company, and then because of the way that you're putting in the complying loan agreement, you're in essence getting taxed again on the same amount, or potentially if it's then a deemed dividend. So that was the double tax part of the decision. Now I do remember it. So.
All right, thank you. I think I've addressed all of the questions that you've all submitted. So thank you for putting those forward. We'll wrap it up there. Just to let you know, there will be a feedback survey circulated by email later today. As always, if you could take a couple of minutes to complete that, it won't take up much of your time, but we're always grateful and interested to hear about any future topics that you'd be interested to hear about. So if you could complete that, we would be appreciative. Other than that, if you do have any other questions, or if you do have any particular client situations that you think would warrant an extra set of eyes or a discussion about how to move it forward, feel free to contact Adrian or myself to have a discussion about that. Otherwise, we will let you get back to your Thursday afternoon. Thank you all for attending, and we hope to see you in the next webinar.